Tmfc is a stock I'm going to talk about in this video. It's the Motley Fool 100 Index ETF, and it's currently trading at $41. We can see, the max over the years. This is from 2018. It was $20. Now it's $41, so it doubled in price. And we see in 5 years, this is around the pandemic crash in March, and it recovered very swiftly. This is 1 year, year to date, 6 months. It's been quite stagnant in the month of July, but you see the steady growth within May and June. 1 month, it's been oscillating around 40 to 41. Yeah, really, just 40 to 41. Oscillating around $1. So I like this stock. Is there a dividend? I never received a dividend from the stock. Yeah, I don't think so. I've heard that there was a dividend, but I've never received a dividend. But anyway, it's great growth. This is a growth ETF. You make good money, good return on your investment just from buying into the stock. You can literally buy it whenever. And it just keeps on growing. And I will show you, there's a 17% return on investment within the year, 34 within 3 years. So it's quite amazing, this stock. You can see the astronomical growth. Let's go to the holdings. So it holds, consumer cyclical, financial services, consumer defense, not very much, but 17% in cyclical and 11% in financial services. That's good. Healthcare, 10%, 20% in communication services, and 34% in technology. So it's heavily weighted on technology in this ETF. So it's basically a technology ETF. It's comprised of 34% of what they consider technology ETFs. Let's go to the equity holdings. So TMFC, we have price per earnings is 31. That's okay. You want this to be low because you want the earnings to be high compared to the price. But again, we're in the growth ETF industry. You have to remember what industry you're analyzing all these indicators so that you can make your own judgments, because if this was a different sector, then this would be horrible. But considering that we're in the growth ETF industry, this is fine. This is acceptable. Price per book, this is actually pretty good. What this is stating that the investors believe that the stock right now is worth 7% of its actual value. So if the ETF was going to liquidate, then it would be, the stock price would be 7%. You divide the stock price by 7 to get the book value. Okay, this is the book value. You want the book value to be higher than the price so that you get a better deal, and therefore you're buying an undervalued stock. But in this case, this is all right. If it's above 1, this is okay. Price per sales, 4, that's pretty good. So the sales, you want the sales to be larger compared to the price, because you want more sales compared to the stock price, which would indicate an undervalued stock. And then cash flow, price per cash flow, 22. It's high. However, for this industry, it's acceptable because it's growth ETF. So let's go to the top 10 holdings. We have Apple, the notorious Apple, the notorious Microsoft, the notorious monopoly Amazon, Google, Alphabet. This is Google. Facebook. So 4% in Facebook, 8% in Google, 8% in Amazon, 9% in Microsoft, and 11% in Apple. That's why the technology is comprised of 34% in this ETF. We have Tesla, Berkshire Hathaway Class B, Visa, Nvidia, Johnson & Johnson. These are all just renowned stocks. So if you want to build your own portfolio that would be comprised in percents like this, you can do that. or you can just easily purchase this ETF, this very renowned growth, hyper growth ETF, in my opinion.